Hi, Stephen from TEFAT. I'm going to give a podcast type format for consolidations in financial accounting. Now in Australia, consolidations are under the AASB 127 standard, Australian Accounting Standards Board Standard 127, and that's International Accounting Standard 127. So what we mean by consolidations is when a parent company has a controlling interest in a subsidiary company, and sometimes the financial statements have to be consolidated, put together. They're called consolidated financial statements. And other times the parent company and subsidiary company has separate financial statements. Whether they are forced to consolidate their financial statement or they just keep their financial statements separate is governed by the accounting standard on consolidations. Now generally, the general rule of thumb is, in Australia at least, if the company has more than 50% voting rights on the board of directors, they need to consolidate the financial statement between the parent and subsidiary company. And if voting rights aren't really in place, you go on the ownership. If there's more than 50% ownership of the parent company into the subsidiary company, then that calls for the need for consolidated financial statements, putting all the entries of the parent and subsidiary into one consolidated statement. But sometimes there's less than 100% control of the subsidiary company, and the minority interests of the subsidiary company have to be left in place. So that controlling interest is a percentage, and that percentage, that controlling interest, determines how much of things like assets, liabilities, equity are controlled by the parent company. And the minority interest is parts of the subsidiary business, items in the financial statements which aren't controlled by the parent company, and they're left in the subsidiary company control. That's minority interest. So the way to start consolidated financial statements is to set all the items that are the same line by line and make adjustments, because if there's 100% control of a subsidiary company, accounts have to be adjusted or even eliminated between the parent and subsidiary to avoid double counting and overstating assets, things like that, so the shareholders get a fair view of accurate financial statements, especially items between the parent company and subsidiary company. So getting back to adjustments, well, a standard is that there's you're not allowed to transfer flows from the subsidiary to the parent company just to prop up financial statements to make it look good for investors. So they're not allowed to dress up the financial statements of the subsidiary company to make it look better to investors. So the any intragroup accounts between the parent and the subsidiary often have to be completely eliminated. Now, this presentation is just like introducing consolidations. I'm not going to give an example. I'll just cover some theory and get you thinking about consolidations and what they are. So if there's an adjustment to increase an item in the parent company, there has to be an offsetting reduction in the subsidiary books, or even elimination of things like such as accounts receivable and accounts payable between the parent and the subsidiary that used to exist in the original state before consolidations. The parent company has to disclose investments in the subsidiary company, and the investment status has to be adjusted, either add or decrease across the two entities, and the items in the subsidiary net assets are taken off the books, paid up capital common stock, which used to be left alone. I just mean part of net assets are taken off the books. Net assets meaning owner's equity. Things such as paid up capital common stock, if it's been changed after the investment, the buyout of the parent company to the subsidiary. So back to the line by line approach, you need to line up the items and keep a column for adjustments, either reduction or increase, or reduction and increase might be to cancel each item out completely. Any gain on the acquisition by the parent company goes into a capital reserve. A capital loss after the acquisition reduces capital, making opposite entries in subsidiary capital. My source, I got some good points from WikiHow online, and have a look at that WikiHow. I found it quite useful, but I will be getting to AASB, which you might find useful if you're in Australia, but often the accounting standards in different countries, such as Canada, for example, are quite similar, because the international accounting standards is across the board, across countries. So after both items, assets, liabilities, income and expenses on the profit and loss statement and balance sheet respectively have been added up, a lot of these entries you simply just add them up. If there's no intragroup transaction, like add up both accounts receivable or accounts payable, inventory, sales in the financial statements, and yeah, if there's no intragroup transactions, just add up the figures. That's not too bad, but intragroup transfers between the parent and subsidiary have to either be added, reduced, or completely eliminated between the two if there's 100% control. And control, like if it's 70% or 90% controlled by the parent company, that means they basically control all the items in the subsidiary financial statements to the level of 70% or 90%. And minority interests are just left alone to the subsidiary that aren't in the parent company's control. Sometimes there's 100% control, full financial decisions and operational decisions by the parent company, but less than 100% is obviously not complete control, and some minority interests remain. And again, that definition, rule of thumb, more than 50% ownership or more than 50% voting rights in the board of directors of the subsidiary company. So also you have to put the acquisition date, that's the date that the consolidation starts, and also if both entities have got different financial periods, under corporations law in Australia, and other various standards and corporations law elsewhere in the world, they have to synchronise the financial statements to exactly the same period, because one financial period might be in another country which has a different financial period. Well, it's got to go to the parent company's financial period of the subsidiary as well, and starting from the acquisition date. And the parent company pays a carrying cost or the acquisition price of the investment in the subsidiary. So items are changed and owned as equity, equity share capital, opposite entries in the parent subsidiary and both balance sheets have to be made to change the owner's equity to reflect the acquisition. Okay, and the parent company gets a share of the profits and owner's equity in the balance sheet according to what percentage control they've got. If they've got 70% control, then they get 70% of the profits and owner's equity. But if it's 100%, obviously that's 100% control of things such as assets and profits and equity. If the parent company bought shares in the subsidiary, you debit capital stock, which is an asset, and credit cash, but the subsidiary capital has to be reduced by the offsetting amount. So capital isn't overstated in the balance sheet. So the subsidiary would credit investment stock, reduce investment on the subsidiary books. You need to reduce the subsidiary capital by a debit any increase in the parent company capital with the equivalent increase or reduction across both entities, owner's equity and the balance sheet respectively. If the parent company gets a dividend from the subsidiary, you debit cash and credit investment. Investment decreases after the dividend, and stocks go ex-dividend. So that means a lower share price for a period until the stock is due for the next dividend. So dividends have to be recorded from the subsidiary to the parent. If there's 100% control, the subsidiary wouldn't be paying the parent company dividends anymore. If a parent company gets a percentage share of the profits, you debit into corporate investment and credit investment revenue. Revenue being a credit item on the P&L. So a simple methodology is add up all the items in the financial statements. When you compare them line by line, make your adjustments, intra-group adjustments, either an increase or reduction less than a full amount, or completely offset or eliminate entries 100% if that item isn't valid anymore, to take it off the books, because you don't want to be duplicating and making figures bigger or lower in financial statements when they're supposed to be either eliminated or just increased or reduced between the parent and the subsidiary. For example, if the sales increase in the parent, sales must be lowered in the subsidiary. You don't want to overstate sales across the two inventory. Also write up inventory transfers. Increase the parent inventory, reduce the subsidiary inventory. And items such as accounts payable, accounts receivable between the parent and the subsidiary would be completely eliminated if there was 100% control. So the entities could either have separate financial statements or consolidated financial statements, or both. It depends on what's required in the country's standard, AASB standard in Australia, which follows International Accounting Standard 127, and so the rule of thumb again in Australia, over 50% voting rights, and if voting rights aren't fully in place, they could be the potential for voting rights to change. You go on the level of percentage of ownership. If it's over 50%, consolidated financial statements are necessary, and you got to state your methodology in the calculation of asset items, liability items, and revenue and expenses in the P&L. For example, if there's separate financial statements, you debit the parent's accounts receivable, credit subsidiary accounts receivable. But if it's consolidated, then you just add up the accounts receivable, taking out intra-group transactions which are eliminated. So you make your adjustments, the debit, accounts receivable, credit sales, and the opposite effect in the subsidiary books if there's separate financial statements. Just reading this. Yeah, but if the accounts receivable and accounts payable as other customers in the marketplace, you would just add up the accounts receivable or the accounts payable as an example and add up the two figures and put it in the consolidated financial statement. If the parent company took on accounts payable with separate statements, you credit accounts payable and debit subsidiary accounts payable, reduce it. But if it's a consolidated statement, you simply add the two figures of the two accounts together. But being careful not to duplicate items, and also eliminating intercorporate transactions between the two, or again what I said, increasing or reducing between the parent and the subsidiary respectively, or the other way around, reducing and then increasing in the subsidiary depending on the item. So I've just going through some more points. Now, consolidated financial statements may be put in place even if there's less than 50% control with ownership or voting rights. If there's substantial financial control decisions and operating decisions by the parent company, whether they need consolidated financial statements is written up in the International Accounting Standard 127. So that standard gives the ruling whether consolidated financial statements should be put in place, so that parent of subsidiary would get clarification by the Australian Accounting Standards Board, as an example, whether they need a consolidated financial statement. And the 50% voting right is a standard in Australia, more than 50%. And if, as I said, if voting rights aren't fully in place, or they're going to change in the future, you go on the ownership figure over 50%. So again, controlling interest percentages could vary: 100%, 90%, 70%. This affects all items on the financial statements by that percentage figure. Things like assets, equity, liabilities affected by the percentage figure. And obviously 70% control is less than 90 or 100% control. And non-controlled items are still listed in the subsidiary books and disclosed as being minority interests or non-controlled items. So that 100% ownership figure, again, eliminate all intercompany transfers and transactions. And just getting some other points. Just stay with me. Yeah, we already mentioned about you might get consolidation if there's less than 50%, if the management decisions are intertwined. The international accounting standards, that's just a verbal description, but the correct term for the international financial reporting standards is just that, IRPS, International Financial Reporting Standards, rather IFRS. I'll just change that, IFRS, okay. And don't forget to outline in the financial statements the parent company's investment in the subsidiary clearly and fully disclosed. Any relevant dividends between the parent and the subsidiary or subsidiary to the parent are disclosed if there's less than 100% control. And put in your methodology of valuations from the old financial statement to the new consolidated financial statements, or if they're separate, just the new financial statements after part of an acquisition. And just looking for some more points. Control could be less than 50% in AASB standard if the parent can remove a board or substantial operating and financial decision control, which also can change, which might change the dynamics of whether consolidation is required. In the public sector, there could even be legislation that may stipulate that a parent must control a subsidiary from Part AUS 13.1 in the AASB Standard 127. So again, just a broad methodology. Line up the financial statements line by line, all the income, expenses, assets, liabilities, add them up. Intragroup items have to be adjusted, add or decrease, and vice versa between parent and subsidiary. Eliminate certain intercompany transfers if there's 100% control. Consolidation starts from the acquisition date. The financial statements have to be synchronized between the two entities. Carrying cost is the cost of the investment by the parent of the subsidiary. Any loss in the subsidiary is offset by future profits of the subsidiary. Any financial flow from the subsidiary to the parent must be disclosed in the financial statements, and it's illegal to dress up the subsidiary financial statements. So my sources WikiHow is useful, have a look at that, and also with the AASB documents, Compiled Accounting Standard AASB 127, Consolidated and separate financial statements. Also another document, AASB Standard Separate Financial Statements, AASB 127. And that's the end of the presentation. That's just an introduction and some terms in consolidation in financial accounting. Again, I'm Stephen from TEFAT, and like the night owl, study hard and burns the midnight oil, students. Good night and bye.